This video aims to present an overview of the world of accounting. Like any other professional area, accounting divides into separate specialist fields. Individual accountants tend to specialize in one of these specialist fields. The first type of accountant we'll discuss is the financial accountant. Now, I know you're probably thinking that all accountants are financial accountants, and this is true. But in accounting, the term financial accountant applies to an accountant with a very specific responsibility. The financial accountant is responsible for preparing 3 reports which are aimed at communicating the well-being of the business. These 3 reports are prepared at regular intervals. These 3 reports are called the profit and loss, the balance sheet, and the cash flow statement. The profit and loss account is often called the income statement or statement of operations. The balance sheet is often called the statement of financial position. We will look in far more detail at the profit and loss, balance sheet, and cash flow statement in future tutorials. But for now, we can say, the profit and loss is a measure of performance of the company. Basically, the profit and loss statement compares the revenue that the company earned with the cost of earning that revenue. This comparison is done for a particular period of time. The balance sheet is a statement of position. This statement tells us what assets the company controls and identifies the ownership of these assets. That is, are the assets owned by the company, or did the company borrow funds to secure control of the assets? Whereas the profit and loss applies to a period, the balance sheet refers to a specific moment in time. Finally, the cash flow statement is exactly that, a statement of cash flows. The cash flow statement presents an analysis of the cash flows into and out of the company. So why does the financial accountant prepare these statements for the company? There's a legal requirement on companies to produce financial statements. If a company is quoted on a major stock exchange, the stock exchange rules require that a company produce a set of accounts at each year end. A set of accounts comprises at least a profit and loss, a balance sheet, and cash flow statement. Additionally, financial accounting information must comply with a legal framework. There are many financial frameworks. Examples include U.S. GAAP, IFRS, that's International Financial Reporting Standards, and many more. One criticism that is often leveled at financial accounting is that by the time the information is presented to stakeholders, the information is historic. The financial accounting information is historic because it takes the financial accountant some time to ensure that the information is prepared in compliance with the legal framework. So typically, a set of financial accounts prepared for a period end will not be published until 2 weeks later. Hence, by the time the end user receives the financial accounts, it's often too late to take any corrective action. It is this fundamental criticism of financial accounting that has led to the development of another accounting discipline. This accounting discipline does not focus on historic reporting for compliance. This accounting discipline prepares predictions of future financial performance. This accounting discipline is called management accounting. Management accounting focuses on the preparation of information that helps business managers manage their companies day to day. Rather than focus on historic information, management accountants help develop and estimate future performance. The financial implications of future performance are captured and documented in an acceptable format. Typically, this format is called a budget or forecast. This budget or forecast contains management's best estimates of future revenues and costs. These estimates of future revenues and costs help managers to understand how the business will perform in the future. If management are satisfied that the budgeted or forecasted performance will meet the expectations of all stakeholders, then management accountants can work with individual managers in the company to help prepare targets that each manager must achieve so that the overall company will perform in line with the budget or forecast. These targets are often called metrics or KPIs. Those are key performance indicators. These are measures that management can use day to day to assess if the performance of the organization is in line with the budget or forecast expectations. If the company performs in line with budget expectations, then the company profit and loss and balance sheet will be as expected by stakeholders such as shareholders. Another aspect of management accounting that differs greatly from financial accounting relates to the framework. Financial accounting information is presented in compliance with a strict framework or set of rules. However, management accounting information does not have such a strict framework. Management accounting information can be presented in whatever fashion the management accountant thinks is best for the business. Hence, the preparation of management accounting information is ad hoc. Thus, the methods used for the preparation of management accounting information differs from organization to organization. There is no common framework that must be adhered to in order to present management accounting information. Management accounting information is presented in whatever format is deemed most suitable to the needs of each separate organization. Many non-accountants find this fact frustrating. However, when we consider that financial accounting information needs to be understood by an external audience, we can see how important it is that financial accounting information is prepared in compliance with an internationally consistent framework. However, the users of management accounting information are predominantly internal. Hence, we can see that it's more important that management accounting information is relevant to the needs of internal users than compliant with the needs of external users. One other set of accounts that need to be prepared relate to tax. Tax accounts are similar to financial accounts in that both tax accounts and financial accounts calculate the profit made by the company in a period. However, the tax rules in each country are different. Thus, companies are required to prepare a separate set of tax accounts to determine the tax expense for each period. The tax expense for each period, calculated from the tax accounts, is then taken as a tax expense to the financial accounts. So, in summary, financial accounts report the financial performance of the company. The main focus is on external reporting to a number of groups: owners, loan creditors, trade creditors, government agencies, employees. In contrast, management accounts provide information to the management team at all levels within the organization for the following purposes: formulating the policies, planning and controlling the activities of the organization, decision-making, and performance appraisal. The management and financial accounts on the next two slides relate to the same business. These are the financial accounts that report the historic performance to external stakeholders in compliance with the financial framework. These are the management accounts that are prepared for internal analysis. The management accounts gives management much more information. Management accounts analyze the cost elements in respect to materials, labor, and overheads. Management accounts allow management to focus on costs which require investigation. Management accounts facilitate decision-making. For example, should product C be discontinued?